Money makes the world go round, but nobody actually knows where it goes. You buy a coffee for $5, and somehow that turns into a business expense that reduces your taxes. What the heck is going on here? Accounting is basically just organized paranoia about money. I mean, at its core, it's the systematic recording, measuring, and communication of financial information. But really, it's just humans being obsessed with keeping track of every single penny because we don't trust ourselves or anyone else. The whole thing started because some Italian guy named Luca Pacioli back in 1494 was like, hey, what if we wrote down our money stuff in a way that actually makes sense, and invented double-entry bookkeeping. Little did he know he was creating the foundation for every stressed-out business student's nightmares for the next 500 years. Here's the thing. Accounting revolves around one magical equation that governs literally everything in business. Assets equals liabilities plus equity, or A equals L plus E. That's it. Every single transaction, every financial statement, every billion-dollar company, it all comes down to this one equation staying balanced. But what does that even mean? Well, assets are stuff you own that has value. Cash, inventory, equipment, that weird office plant nobody waters but somehow stays alive. Liabilities are what you owe other people. Loans, unpaid bills, that $20 you borrowed from your coworker for lunch 3 months ago. And equity is basically what's left over. It's the owner's slice of the pie after you pay off all your debts. So if you have $100,000 in assets and $30,000 in liabilities, your equity is $70,000. The equation stays balanced, and accountants everywhere sleep peacefully knowing the universe is in order. Now here's where it gets interesting. Every time something happens in business, and I mean every time, this equation has to stay balanced. Buy inventory with cash, assets shift around, but the total stays the same. Take out a loan, assets go up, liabilities go up, equation balanced. It's like financial conservation of energy, except way more stressful. This is where double-entry bookkeeping comes in, and it's actually kind of genius. For every transaction, you make at least 2 entries, a debit and a credit, and they have to equal each other. Debits increase assets and expenses, while credits increase liabilities, equity, and revenue. Yeah, I know it sounds backwards because your bank statement shows credits as money coming in, but that's because the bank is looking at it from their perspective, and to them, your deposit is their liability. Banks are basically financial magicians. Welcome to Accounting Pro Tips Season 1. Tip of the day. Never trust anyone who says accounting is just common sense. If it were common sense, half the world's businesses wouldn't collapse from basic bookkeeping errors. Yeah, that's it. Have a great day. But let's talk about what businesses actually do with all this number tracking madness. The main output of all this obsessive record keeping is financial statements, which are basically report cards for grown-ups who run companies. The first one is the balance sheet, which is just the accounting equation dressed up in fancy formatting. It shows what you own, what you owe, and what's left over at a specific point in time. It's like a financial snapshot. Here's where we stand on December 31st at 11:59 p.m., and don't ask what happened 1 minute later. Then there's the income statement, also called the profit and loss statement, or P&L, which shows whether you made or lost money over a period of time. Revenue minus expenses equals net income. If that number is positive, congratulations, you made money. If it's negative, well, at least you tried. The third major statement is the cash flow statement, which tracks how cash moves in and out of the business. This one's important because you can be profitable on paper, but still run out of cash to pay your bills. It's like having a really high credit score, but only $5 in your checking account. Technically impressive, but practically useless. Oh yeah, did I mention that there's different types of accounting? Because apparently, regular accounting wasn't complicated enough, so humans invented variations. There's financial accounting, which is what we've been talking about, recording transactions and creating statements for external users like investors, creditors, and regulators. It follows standardized rules called GAAP, Generally Accepted Accounting Principles, which is basically a rule book that accountants worship like a religious text. Then there's management accounting, which is internal accounting for decision making. This is where businesses figure out whether launching that new product line will make them rich or bankrupt. It includes budgeting, forecasting, and cost analysis, basically trying to predict the future with spreadsheets. Tax accounting is its own special nightmare because the IRS has their own rules that often contradict GAAP, meaning companies have to keep multiple sets of books. It's like being bilingual, except both languages are designed to make you cry. And forensic accounting is basically financial detective work, following money trails to catch fraud, embezzlement, and other creative ways people steal money. These accountants are like Sherlock Holmes, except instead of solving murders, they're solving missing cash and fake invoices. Now, let's talk about revenue recognition, which sounds boring, but is actually where a lot of companies get creative with their numbers. The basic principle is that you record revenue when you earn it, not necessarily when you get paid. Sell something in December, but get paid in January? That's December revenue. But what does earn mean? If you're Netflix and someone pays for a year-long subscription, you can't just dump all that money into revenue immediately. You have to spread it out over the year as you actually provide the service. This is called deferred revenue, and it sits on your balance sheet as a liability because you owe the customer those future months of content. The matching principle works the same way for expenses. You match them with the revenue they help generate. If you buy $10,000 worth of equipment that will help you make money for 5 years, you don't expense it all at once. You depreciate it over 5 years, expensing $2,000 each year. It's like financial meal prep, spreading costs out over time. Speaking of depreciation, this is where accounting gets really philosophical. That equipment you bought, it's losing value over time through wear and tear, obsolescence, or just the passage of time. Depreciation is how accountants acknowledge that nothing lasts forever, which is both practical and existentially depressing. There's different methods of depreciation. Straight line spreads the cost evenly over time, accelerated methods front-load the expenses, and some methods tie depreciation to actual usage. It's like choosing how to eat a pizza, all at once, saving the best for last, or measuring each bite. But wait, there's more. Businesses also have to deal with inventory accounting, which is surprisingly complex for we bought stuff and then sold stuff. The main question is, when you sell something, which specific item did you sell? The one you bought first, last, or somewhere in the middle? FIFO, first in, first out, assumes you sell your oldest inventory first, like a grocery store rotating stock. LIFO, last in, first out, assumes you sell your newest inventory first, like a pile of newspapers where you take from the top. The weighted average method just averages everything together, because apparently some accountants gave up on tracking individual items. This matters because if prices are changing, different methods give you different profit numbers. During inflation, FIFO shows higher profits because you're matching current selling prices with old, lower costs. LIFO shows lower profits because you're matching current prices with recent, higher costs. It's the same business, same inventory, but different numbers depending on your accounting method. Welcome to the magical world of professional number manipulation. Okay, let's recap. We track assets, liabilities, and equity using double-entry bookkeeping, create financial statements to communicate results, recognize revenue when earned, and match expenses accordingly, and depreciate assets over time while using various methods for inventory accounting. AKA, we've organized our financial paranoia into a coherent system. But why does any of this matter? Because businesses need this information to make decisions. Should we expand? Can we afford that new hire? Are we profitable enough to take on more debt? Without accounting, business decisions would just be expensive guessing games. Investors use financial statements to decide where to put their money. Banks use them to decide whether to lend money. The government uses them to calculate taxes. Employees use them to gauge job security. It's like a financial universal language that lets everyone communicate about money stuff. And here's where it gets really interesting. Accounting directly impacts the economy. When companies manipulate their numbers, legally or illegally, it affects stock prices, investment decisions, and market confidence. Remember Enron? They were creative with their accounting until creativity became fraud, and the whole company collapsed, taking investors' money and employees' jobs with it. This is why we have auditors, independent accountants who check other accountants' work. It's like having a teacher grade your homework, except the homework is worth billions of dollars and affects thousands of people's lives. No pressure. But even legitimate accounting involves judgment calls. How long will that equipment last? How much of that receivable will customers actually pay? What's the probability that lawsuit will cost us money? Accountants have to make estimates about uncertain future events, which is basically professional fortune-telling with spreadsheets. Modern accounting also deals with digital complexities. What's the value of customer data? How do you account for cryptocurrency? If your company's main asset is an app, how do you put a value on code? These questions would have made Luca Pacioli's head spin, but somehow we're making it work. Technology has transformed accounting from endless manual calculations to automated systems that can process thousands of transactions instantly. But humans still need to understand the principles because computers are really good at following rules, but terrible at judgment calls. When something weird happens, and something weird always happens in business, you need humans who understand the underlying logic. The future of accounting is getting even more interesting. Artificial intelligence is automating routine bookkeeping. Blockchain technology might revolutionize how we track transactions, and real-time financial reporting could replace traditional quarterly statements. But no matter how fancy the technology gets, the fundamental question remains the same. Where did the money come from? Where did it go? And do we have any left?